In 2 days, the Federal Reserve makes a decision that could shake every dividend stock that you own, and almost nobody holding SCHD is talking about it. On July 28th and 29th, the Fed meets to decide what happens next with interest rates. Right now, markets are genuinely split on which way it goes, and that kind of uncertainty alone is often enough to move dividend funds like SCHD before the decision even lands. If a hike does happen, dividend funds like SCHD usually take the first hit. So today we're not looking at what already happened to your dividend. We're looking at what could happen next and whether the companies inside SCHD are actually strong enough to handle it either way. Before we go further, this video is for education only. I am not a licensed financial advisor. All the data is from public sources. Please check the numbers yourself and talk to a qualified professional about your own situation. Here is why a rate hike matters so much for SCHD specifically. When interest rates rise, safer options like treasury bonds start paying more. That makes SCHD's yield look less attractive by comparison, and investors sometimes rotate money out of dividend funds and into bonds instead. On top of that, higher rates raise borrowing costs for the companies inside SCHD, which can squeeze their cash flow right when they need it to keep raising dividends. That is the real risk, not the fund itself falling apart, but the environment around it getting tougher. This is exactly the kind of moment where headlines get loud and investors make decisions they later regret. So let's slow down and actually look at the facts before this decision lands. So the question worth asking 2 days before this decision is simple. If rates do go up, can SCHD's underlying holdings actually handle it? Or will this be the quarter that finally tests the streak? Let's stop guessing and look inside the fund and find out. Start with the strong ones. Coca-Cola is a perfect example of what SCHD is built to hold. Its profit margin is growing, its cash flow is climbing fast, and its dividend just went up again, extending a streak past 6 decades. A rate hike barely moves the needle for a company like this. AbbVie is another one carrying real weight. Its revenue is climbing at a fast pace. Its guidance was raised, and its dividend went up again too. The 5th straight yearly increase. These are the holdings that keep paying no matter what the Fed decides. Now here is the honest part. A couple of SCHD's bigger holdings deserve a closer look, especially with higher rates on the table. Some, like Lockheed Martin, are currently paying out more in dividends than they bring in from free cash flow this quarter, tied mostly to program costs and timing. Others, like Chevron, saw cash flow turn negative on working capital and timing issues. Even while its full-year cash generation and decades-long streak stayed strong, neither company is likely to cut its dividends soon. And both have weathered tighter conditions before without breaking their own streaks. But these are exactly the holdings that would feel a rate hike first, since any added pressure lands on companies already running tighter than usual. That does not mean panic. It means these are the 2 names worth watching over the next few weeks. Here is why this matters for your wallet. SCHD's top 10 holdings make up a little over 40% of the whole fund. That means a small group of companies carries outsized power over how your quarterly check reacts to whatever the Fed decides. If rates rise and a couple of these bigger names feel the pressure, you will likely see it show up as noise, not as a broken streak. The other 90 holdings are still doing their job in the background, quietly collecting cash flow and paying it forward no matter what happens in Washington. Let's put a number on what can handle it really means. SCHD's index requires at least 10 straight years of dividend payments just to be considered. Then it ranks survivors on cash flow versus debt, return on equity, dividend yield, and 5-year dividend growth. That screen was built specifically to filter out companies that fall apart the moment conditions get harder. It has already been tested through past rate hikes and past downturns, and the streak held every single time. That track record is not a guarantee, but it tells you this fund has been through this exact scenario before. Let's make this real with a simple example. Say you hold a $50,000 position in SCHD. Roughly 40% of that, about $20,000 worth, is riding on the health of just 10 companies. If a rate hike puts real pressure on 1 or 2 of those names, it would still only be a small slice of your total income, since the other 90 holdings keep paying regardless of what the Fed does. That is the whole point of owning a fund instead of a single stock. No one Fed decision can sink your income on its own. This is not the first time SCHD has faced a hiking cycle. The fund has lived through multiple rounds of Fed rate increases since its launch, including some of the steepest hikes in decades. Its dividend kept climbing through every single one of them. That does not mean this time is guaranteed to look the same. but it does mean the 14-year streak was not built during easy conditions. It was built while absorbing exactly this kind of pressure again and again. Now, the myth I want to clear up before this decision lands: some investors think that any Fed rate hike automatically means dividend cuts are coming. That is not how it works. A rate hike raises pressure. It does not force a company to cut a dividend it can otherwise afford. SCHD's holdings would need a much deeper, longer squeeze, not just one Fed decision, before the streak is genuinely at risk. A single meeting is a data point, not a verdict. So here is the honest bottom line. If the Fed hikes rates on the 29th, expect some short-term noise in SCHD's price and maybe some pressure on the holdings I flagged today. That is normal, and it is not the same thing as your income being unsafe. The 14-year streak was not built by avoiding hard quarters. It was built by holding through them. Here's your action step. Mark July 29th on your calendar. When the Fed's decision comes out, come back and check how SCHD's price reacted that day, then check it again a week later. You will see firsthand whether this was noise or something bigger, instead of just reacting to a headline. That single habit, watching how a fund actually behaves around a big event instead of just reading the headline about it, will make you a calmer investor for the rest of your life. Drop what you're watching for in the comments below. If this helped you get ahead of the next big move instead of reacting to it, hit subscribe. We call out what's coming before it happens, not just after. See you in the next one.